Right now, at this exact moment, we're standing at what might be the most critical crossroads in the precious metals market that we've seen in months. And I'm not going to sugarcoat this for you. What happens over the next few days, maybe even the next few hours, could determine whether the recent rally in gold and silver continues its march higher, or whether we're about to see a reversal that catches a lot of people off guard. The signals are mixed, the pressure is building, and the smart money is starting to make moves that should have your full attention. If you're holding positions in metals or mining stocks, or if you've been watching from the sidelines trying to figure out your next move, you're in the right place. Because we're going to break down exactly what's happening beneath the surface, what the key levels are, and most importantly, what you should be watching for in the days ahead. Before we dive deep into the charts and the data, if you haven't already, go ahead and hit that subscribe button right now. This is Element Axis. And we focus on cutting through the noise to give you actionable insights on markets, metals, and strategies that matter to real investors like you. We don't do hype here, we do analysis. And if that's what you're looking for, you're going to want to stay connected, because things are moving fast right now. So here's where we stand. It's February 2026, and the precious metals market is giving us what I call a tension pattern. You know what that is? It's when price is coiled up, sitting right at levels that could break either direction, and everyone's waiting to see which way the rubber band snaps. Gold is pressing against a ceiling it's been struggling to break through. Silver is trapped in a range that's testing everyone's patience. And the mining stocks, well, they're sending signals that aren't exactly reassuring if you're bullish. Now, does that mean you should panic? Absolutely not. But it does mean you need to be paying attention to specific levels and specific signals. Because the difference between making money and losing money in markets like this comes down to preparation and discipline, not hope. Let me start with what just happened in Asia, because this is a development that's flying under the radar for a lot of people, but it matters. The Shanghai Futures Exchange just raised margin requirements again. We're talking about gold margin now sitting at 19%, and silver margin at 22%, and they've also implemented daily trading limits, plus or minus 17% for gold, and plus or minus 20% for silver. Now, if you're not deeply familiar with how futures markets work, let me explain why this is significant. When an exchange raises margin requirements, what they're doing is forcing traders to put up more cash to hold the same position. And if those traders don't have that extra cash sitting around, they have two choices. They either reduce their position size, or they get liquidated. There's no middle ground. So what ends up happening is that traders who were operating on tight margins suddenly find themselves forced to exit positions, whether they want to or not. And here's the kicker. This isn't just happening on one exchange. The CME Group, which is the major futures exchange in the United States, did something very similar just days before Shanghai made their announcement. So now you've got the two largest futures exchanges in the world, simultaneously making it more expensive and more risky to hold leveraged positions in precious metals. Whether this is coordinated or just a reaction to similar market conditions, the effect is the same. The market is getting squeezed. And when markets get squeezed like this, they don't behave normally. You start seeing volatility spikes. You start seeing forced selling. That has nothing to do with fundamentals and everything to do with position management. And that creates opportunities for some people and real pain for others, depending on which side of the trade you're on. Now, let me give you the specific levels that matter right now, because without levels, you're just guessing. For gold, the immediate focus is around $5,100. That's the price point where the recent rally has been stalling out. Every time gold pushes up toward that level, it runs into selling pressure. Not violent rejection, but consistent resistance. And when you see a level act like that repeatedly, you have to respect it. There are sellers positioned there, there's supply at that price, or they get liquidated. There's no middle ground. So what ends up happening is that traders who were operating on tight margins suddenly find themselves forced to exit positions, whether they want to or not. And here's the kicker. This isn't just happening on one exchange. The CME Group, which is the major futures exchange in the United States, did something very similar just days before Shanghai made their announcement. So now you've got the two largest futures exchanges in the world, simultaneously making it more expensive and more risky to hold leveraged positions in precious metals. Whether this is coordinated or just a reaction to similar market conditions, the effect is the same. The market is getting squeezed. And when markets get squeezed like this, they don't behave normally. You start seeing volatility spikes. You start seeing forced selling. That has nothing to do with fundamentals and everything to do with position management. And that creates opportunities for some people and real pain for others, depending on which side of the trade you're on. Now, let me give you the specific levels that matter right now, because without levels, you're just guessing. For gold, the immediate focus is around $5,100. That's the price point where the recent rally has been stalling out. Every time gold pushes up toward that level, it runs into selling pressure, not violent rejection. but consistent resistance. And when you see a level act like that repeatedly, you have to respect it. There are sellers positioned there. There's supply at that price. And until the buyers can absorb that supply and push through, gold is stuck below it. On the downside, the level that's been holding is around $49.90. Pullbacks toward that area have been met with buying interest over the past several sessions. So you've got a range, $49.90 on the low end, $51.00 on the high end. Everything that happens inside that range is just noise. The real signal comes when we break out of it in either direction. If gold can break above $51.00 and hold that level, the next targets come into view pretty quickly. You're looking at $53.00. Beyond that, the January high around $54.50. And then the all-time high up near $56.00. That's the bullish scenario. But if the market breaks down instead, if we lose $49.90 with volume and follow-through, then $49.00 becomes the next support to watch. Below that, $48.00. And then the February 6th low around $46.56. That's the bearish scenario. Now let's talk about silver, because silver has its own personality. It's more volatile, more emotional, and more prone to sharp swings. Right now, silver is stuck in a frustrating range. The key level on the upside is $84. That level has been flipping between support and resistance. Some days it holds, other days it rejects price. That tells you the market is undecided. Bulls and bears are evenly matched. Whoever wins 84 controls the next move. On the downside, $79 has been the floor. Dips toward that level have been bought. That's where demand is showing up. So again, you have a range. 79 on the bottom, 84 on the top. Break above 84 with momentum. And the first target is 92.20, then 95.90, then the psychological level at $100. If 100 breaks with strength, all-time highs come back into play. But if 79 fails, then 75 becomes critical. And below that, the February 6th low around 64.90. That would be painful, but it would also create opportunity for anyone with cash and patience. Here's what's making me cautious, though, and I want you to pay attention. The momentum indicators are not confirming price. RSI on the 14-period setting is rolling over, sitting just above the neutral 50 level. That's not what you want in a healthy uptrend. You want rising momentum. You want strength building. Instead, it's flat to declining. The MACD is also struggling. It barely moved into positive territory and immediately started flattening. That's not conviction, that's hesitation. When price presses resistance while momentum fades, that's a yellow flag. It doesn't mean a breakout can't happen, but it means the bulls have to prove it, with volume and follow-through. Until then, every rally deserves skepticism. Now, I want to tell you about something that happened recently that I think is worth your attention. There's a billionaire trader in China named Ben Shaming. This guy is well known in Chinese futures markets. He made close to $3 billion riding the gold rally from 2022 onward. $3 billion. That's not a small win. That's one of the most successful commodity trades of the decade. He was one of the biggest bulls on gold on the Shanghai Futures Exchange, and he absolutely crushed it. But here's what's interesting. He's not bullish on silver anymore. In fact, he's now holding the largest net short position on silver on the entire Shanghai Exchange. He's short approximately 30,000 contracts, which translates to around 450 tons of silver. At current prices, that position represents roughly $300 million in exposure. Let me say that again. A guy who made $3 billion being right about precious metals is now betting $300 million that silver is going to go down. Now, does that automatically mean he's right? No, of course not. Even the best traders in the world get their calls wrong sometimes. And, according to reports, he's already had to exit some of his short positions at a loss earlier because silver bounced when he thought it wouldn't. He started building this short position in late January, trying to call the top of the rally. That's notoriously difficult to do with any precision. But the fact that someone with his track record, with his resources, with his access to information, is positioned this way, that's worth paying attention to. According to the data, his current short position has generated substantial paper profits. After accounting for his earlier losses from mistiming parts of the trade, he's still sitting on what amounts to a massive win if he were to close the position at current levels. Does that mean you should blindly follow what he's doing? Absolutely not. His risk tolerance is not your risk tolerance. His time horizon is not your time horizon. He can afford to be wrong in ways that most individual investors simply cannot. But what it does mean is that you should at least consider the possibility that silver's recent rally may have been driven more by speculation and positioning than by fundamental factors. And if that's the case, then the air can come out of that balloon faster than most people expect. Drop a comment below and tell me what you think. Do you think this billionaire trader is right and silver is already topped? Or do you think he's going to get caught in a short squeeze when silver rips to new highs? I'm genuinely curious to hear what you're thinking. Let me zoom out for a second and talk about the bigger picture, because it's easy to get caught up in the day-to-day price swings and lose sight of why we're paying attention to precious metals in the first place. The structural case for gold and silver has not changed. Global debt levels are still at record highs. Fiscal deficits in major economies are still massive. Central banks around the world are still accumulating gold for their reserves. The dollar, despite showing some strength recently, is still in a long-term weakening trend when measured against hard assets. Industrial demand for silver continues to grow, driven by solar panel production, electric vehicle manufacturing, 5G infrastructure build-out, and increasingly by artificial intelligence and data center expansion. The supply side remains constrained, with mining production struggling to keep up with demand. None of those fundamental factors has changed because of a bad week of price action or because an exchange raised margin requirements. Those are the long-term drivers that matter over years, not days. But here's the nuance that a lot of people miss. Fundamentals tell you where price should go over the long term. Positioning and sentiment tell you where price is likely to go in the short term. And right now, the short-term picture is messy. Positioning is stretched. Sentiment has shifted from euphoric to cautious. Margin requirements are making it harder for new leveraged money to enter the market. And the technicals are showing that we're stuck in ranges that could break in either direction. That's why having a plan is so much more important than having an opinion. You can believe in the long-term case for metals while still recognizing that the short term is uncertain. Those two things aren't contradictory. They're just different time horizons. And if you don't distinguish between them, you end up making emotional decisions that hurt your returns. Let me give you a framework for how to think about this. There are essentially 3 scenarios that could play out from here, and you should have a plan for each one before it happens. Scenario 1 is the bullish breakout. Gold clears 5100 and holds above it. Silver breaks through 84 and follows through to the upside. Miners start participating with volume and strength. If that scenario unfolds, that's your signal to add exposure or to hold existing positions with confidence. The breakout itself is the confirmation you're looking for. Until that happens, you're just guessing. Scenario 2 is the continued chop. Gold stays stuck between 49.90 and 5100. Silver stays trapped between 79 and 84. Miners go sideways. If that scenario plays out, the right move is probably to hold your core positions, but not add. Choppy markets are frustrating, but they're not dangerous if you're sized appropriately. The danger comes from losing patience and making a move just because you're bored. Don't do that. Scenario 3 is the breakdown. Gold loses 49.90 with conviction and volume. Silver breaks below 79. Miners start making lower highs and lower lows. If that scenario unfolds, the right move is probably to reduce exposure, take some profits if you have them, or step aside entirely to preserve capital. There's no shame in moving to cash during a correction. Cash is a position. And having the ability to buy back lower is a huge advantage that most people don't take advantage of because their ego won't let them admit they were wrong. The key is deciding ahead of time what you'll do in each scenario, because once you're in the middle of a sharp move, emotions take over. Your brain doesn't function as clearly when you're watching your account value swing around in real time. That's why you make the decision now when you're calm about what you'll do when specific levels get hit. Then when those levels actually hit, you execute the plan without hesitation and without second guessing. That's discipline. And discipline is what separates people who build wealth over time from people who get lucky once and then give it all back. Let me talk about the mining stocks for a minute because this is where a lot of people have their exposure, and it's where the leverage lives. Mining stocks amplify the move in the underlying metal. When gold goes up 10%, miners might go up 30%. But when gold drops 10%, miners can drop 30% or more. That amplification cuts both ways. And right now, the miners are not acting particularly strong. If you look at the major mining ETFs, both for gold and silver, they've been lagging the performance of the metals themselves recently. That's not what you want to see in a healthy bull market. In a strong uptrend, miners typically lead. They outperform the metal on a percentage basis because the market is pricing in the operating leverage, the expanding profit margins, the earnings growth that comes with higher metal prices. When miners start lagging or underperforming the metals, it's often an early warning sign that the rally is getting tired or losing momentum. Now, that doesn't mean miners can't catch up. They absolutely can. If we get that bullish breakout scenario where gold clears 5,100 and silver clears 84, miners will probably rip higher and make up for lost ground very quickly. But until that happens, the divergence between the metals and the miners is something you need to be aware of. It's one of those subtle signals that tells you something might be off beneath the surface. For the mining stocks specifically, you want to be watching key support and resistance levels just like you do with the metals. You want to watch volume patterns to see if institutions are accumulating or distributing shares. And you want to watch relative strength compared to the metals. If miners start outperforming, that's a bullish sign. If they keep lagging, that's a caution flag. Before we wrap up, I want to talk about something psychological because this is ultimately where most people either win or lose in markets. The market is designed to mess with your head. It's designed to make you feel maximum fear at the bottom and maximum confidence at the top. It's designed to shake you out of good positions right before they work and trap you in bad positions right before they break down. And the only real defense against this is self-awareness. So let me ask you right now, how are you feeling about your positions in metals? Be honest with yourself. Are you calm and confident, willing to hold through whatever volatility comes? Or are you anxious and uncertain, checking prices multiple times a day, hoping for a bounce? Because how you feel tells you something important about your position sizing and your time horizon. If you're feeling anxious, that usually means one of two things. Either your position is too large for your actual risk tolerance, or your time horizon is too short for the type of asset you're holding. Both of those are fixable, but you have to be honest about which one applies to you. If your position is too large, the solution is straightforward. Reduce it until you can sleep at night. There's no magic formula for the right position size. The right size is whatever allows you to think clearly and act rationally when the market moves against you. If you're making emotional decisions, if you're obsessively checking prices, if you're losing sleep, your position is too big. Period. If your time horizon is too short, you have two choices. Either extend your horizon and commit to holding through the volatility, or acknowledge that you're not really investing, you're trading. And if you're trading, you need stop losses. You need clear exit rules. You need a completely different approach than someone who's investing for the long term. Most people fall somewhere in the middle, which is actually the worst place to be. They have the position size of a long-term investor, but the patience of a day trader. They hold positions that are too large to be comfortable with, but they refuse to use stops because they think stops are only for short-term traders. And then when the market moves sharply against them, they freeze. They do nothing. And they watch unrealized gains turn into real losses because they never actually defined what game they were playing. Don't be that person. Define your game. Size your positions appropriately for that game, and have a clear plan for every scenario you might face. So where does all this leave us? Here's the bottom line. Gold and silver are at critical decision points. The levels are clear. Gold has resistance at 5,100 and support at 4,990. Silver has resistance at 84 and support at 79. Those are the lines in the sand. What happens at those levels over the next few days is going to tell us which scenario we're heading into. The margin situation is tightening across multiple exchanges. That's squeezing out leveraged speculators and making it harder for new money to flow into the market. It's not necessarily bearish for the long term, but it does remove some of the fuel that was driving the recent rally. The momentum indicators are showing caution. They're not confirming the bullish case yet. Until they do, every rally attempt has to prove itself with actual price action and volume, not just hope. The smart money appears to be divided. You've got a billionaire who made $3 billion on the gold rally, now betting $300 million that silver goes down. You've got institutions reducing exposure in some areas. You've got short interest in mining stocks sitting at elevated levels. That doesn't automatically mean they're right, but it does mean the consensus has shifted from euphoria to caution. Given all of that, having a defensive posture makes sense right now. That doesn't mean selling everything in a panic. It means having core positions you believe in, but also having defined levels where you'll add if we break out, or where you'll reduce if we break down. It means not hoping for a specific outcome, but being prepared for multiple possible outcomes. Hope is not a strategy. Hope is what you do when you've run out of strategy. If you found this breakdown helpful, do me a favor and hit that like button. It helps the algorithms show this content to more people who might benefit from it. And drop a comment below telling me where you stand in this market. Are you adding to positions here? Are you holding steady? Are you taking some profits off the table? What's your plan if we break out? What's your plan if we break down? I read the comments, and I'm genuinely interested in hearing how you're approaching this. Also, if you know someone who's holding metals right now and trying to figure out their next move, share this video with them. Sometimes the most valuable thing you can do for someone is help them think more clearly about a difficult decision. The market is at a pivot point. The charts aren't screaming bullish, and they're not screaming bearish. They're in that frustrating middle zone where patience and discipline matter more than opinions. The margin squeezes are making it tougher for the leverage crowd to stay in the game. The smart money is making moves that suggest caution. My job here at Element Axis isn't to tell you what to do. It's to give you the information and the framework to make your own informed decisions based on your own situation. Whether we break out to new highs or break down to test the lows, being prepared for both possibilities is what separates people who survive and thrive in markets from people who get caught off guard. Stay sharp, stay disciplined, and we'll see you in the next one.